How to choose the right small business line of credit, and why it matters. Did you know that even businesses making $100,000 plus monthly can collapse when they can't bridge a 30-day payment gap? I've seen it happen to a landscaping company with 20 employees and $2 million in annual revenue. They were profitable on paper but couldn't cover payroll during what should have been their most profitable quarter. The right line of credit could have saved them. Today I'll show you how to select the perfect small business line of credit that works as hard as you do. Welcome back to the channel where we help business owners like you make better financial decisions. If you're running a successful small business bringing in $100,000 plus monthly, you likely understand cash flow, working capital, and basic business finance. But when it comes to lines of credit, the options can be overwhelming. The wrong line of credit could lock up your business capital when you need it most, but I'll show you how to avoid that trap. In this video, you'll learn 1. The 5 critical factors that determine which line of credit is right for your business. 2. Why the wrong choice could cost you thousands in unnecessary interest and fees. 3. How to match credit options to your specific business needs. 4. The exact application steps that increase your approval odds. 5. And one little known detail about lines of credit that most lenders won't tell you. Let's start with what makes business lines of credit different from standard loans. Understanding business lines of credit. A small business line of credit gives you access to a pool of funds you can draw from whenever needed, similar to a credit card, but typically with better interest rates and higher limits. Unlike a loan, you only pay interest on what you use. For example, John runs a landscaping business making $150,000 monthly, but faces a cash gap during winter months. With a $200,000 line of credit, he draws only $75,000 to cover expenses and pays interest solely on that amount, not the full $200,000. Business lines of credit come in 2 main forms. 1. Secured lines require collateral like equipment or inventory. 2. Unsecured lines don't require specific assets but typically have higher interest rates. The revolving nature of these credit lines means that as you repay what you've borrowed, that amount becomes available again during your draw period. This creates ongoing financial flexibility that standard business loans simply don't offer. There's one type of line of credit that banks push heavily but is actually terrible for seasonal businesses. I'll reveal which one in a moment. But first, let's examine the 5 factors that determine which line of credit best fits your business. 5 critical selection factors. Factor 1. Credit limit size. Your credit limit needs to align with your business requirements. Too small, and it won't cover your needs. Too large, and you might pay unnecessary fees. Ask yourself, what's the largest cash gap you typically face? Most successful businesses need at least 1-2 months of operating expenses available. For a business earning $100,000 monthly with $70,000 in monthly expenses, a $150,000 line provides adequate coverage without excessive fees. Factor 2. Interest rates and fee structure. Interest rates for business lines of credit typically range from 7% to 25%, depending on your credit score, business history, and whether the line is secured or unsecured. Beyond the base interest rate, watch for 1. Annual maintenance fees. 2. Draw fees each time you access funds. 3. Unused line fees charged on the portion you don't use. I worked with a retail client who saved $7,000 annually by switching to a line with a slightly higher interest rate, but no unused line fees, because she only needed the full amount during 2 months of the year. The third factor is where 80% of businesses make a critical mistake that costs them thousands. Don't worry, I'll show you how to avoid it. Factor 3. Repayment terms. Repayment terms dictate how quickly you must repay what you borrow. Some require interest-only payments during the draw period with principal payments later, while others require regular principal and interest payments. Here's the mistake. Many business owners focus only on getting the highest limit possible but ignore repayment structures. A construction company client of mine nearly went under with a line that demanded full principal repayment during their slowest season, the exact wrong timing for their business cycle. They specifically switched to a line allowing interest-only payments during winter months when projects slowed down, and it saved their business. Factor 4. Eligibility requirements. Lenders evaluate 1. Business credit score, typically needing 680 plus for the best rates. 2. Time in business, usually minimum 2 years. 3. Annual revenue, often $100,000 minimum. 4. Profitability history. 5. Personal credit scores of business owners. Know your numbers before applying. Pull your business credit report, understand your debt-to-income ratio, and calculate your debt service coverage ratio, your net operating income divided by total debt obligations. Factor 5. Application process and funding speed. When cash flow gaps arise, timing matters. Application processes vary dramatically. 1. Traditional banks, 3-4 weeks for approval, extensive documentation. 2. Online lenders, 24-72 hours, streamlined documentation. 3. Credit unions, 1-2 weeks, moderate documentation if you need funds quickly. An online lender might be worth slightly higher interest rates. If you have time, a traditional bank typically offers the best rates. Comparing your options. Now let's compare the primary sources of business lines of credit. Traditional banks. 1. Lowest interest rates, typically 7-13%. 2. Highest credit limits, often $100,000 to millions. 3. Slowest approval, 2-4 weeks. 4. Strictest requirements, 2+ years in business, strong credit. 5. Example, Bank of America offers lines from $10,000 to $100,000 with rates starting at 7.75% for well-qualified businesses. Credit unions. 1. Competitive rates, typically 9-15%. 2. Moderate limits, $50,000 $250,000. 3. Moderate approval time, 1-2 weeks. 4. Slightly more flexible requirements. 5. Often require membership. 6. Example, Navy Federal Credit Union offers business lines up to $100,000 with rates from 9.15%. Online lenders. 1. Higher rates, typically 10-25%. 2. Fast approval, often 24 hours. 3. More accessible qualification requirements. 4. Examples include Cabbage and On Deck with lines up to $250,000 and starting rates at 10-13%. SBA lines of credit. 1. Competitive rates, typically 7-10%. 2. Higher limits, up to $5 million. 3. Longer application process, 30-90 days. 4. Government backing allows for more flexible approval. 5. Example, SBA Cap Lines program offers lines up to $5 million, with rates typically prime plus 2.25%. Before I share which option worked best for my manufacturing client, let me show you a quick calculation that banks hope you never learn about. Many business owners focus only on the interest rate, but the true cost includes all fees spread across your actual usage. For a $100,000 line with 10% interest that you use only $40,000 of, a 1% unused line fee adds an effective 1.5% to your rate on the borrowed portion. Run this calculation before signing. True cost equals interest on used portion plus all fees, divided by amount actually used. My client with an established manufacturing business secured an SBA line at 8.5% despite previous credit challenges, something traditional banks wouldn't accommodate. The slightly longer approval process saved them over $14,000 annually compared to their quickest option. Application process. A successful application requires preparation. Here's what you need. Documentation checklist. 1. Business and personal tax returns, 2-3 years. 2. Bank statements, last 3-6 months. 3. Profit and loss statements. 4. Balance sheets. 5. Business plan or projection, for newer businesses. 6. Business licenses and registrations. 7. Personal and business credit reports. I'll show you the one document that loan officers secretly weigh more heavily than any other. It's not what most people think. While they ask for everything on this list, my insider contacts at 3 major lenders confirm they scrutinize your accounts receivable aging reports most carefully. Why? They're looking for concentration risk, whether your business depends too heavily on just a few customers. A diverse customer base with consistent payment histories dramatically improves your approval odds. Application steps. 1. Research and select 2-3 potential lenders based on your needs. 2. Gather all documentation before starting applications. 3. Submit applications within a 14-day window to minimize credit inquiry impact. 4. Follow up within 3-5 business days if you haven't heard back. 5. Review offers carefully, comparing total cost, not just interest rates. Application tips. 1. Apply when your business shows strong financial performance. 2. Address potential red flags proactively in your application. 3. Consider building a relationship with the financial institution first. 4. For traditional banks, meet with a business banking officer in person when possible. The secret most lenders won't tell you. Now for the revelation that could save your business during tough times. Here's what most lenders don't advertise. Many business lines of credit come with demand clauses, allowing them to reduce your credit limit or call the line due with minimal notice. This hidden clause crushed a $5 million business during the last economic downturn. Here's exactly how to protect yourself. This manufacturing company had a $750,000 line they relied on for inventory purchases. When market conditions worsened, their bank invoked the demand clause, slashing their limit to $250,000 overnight and demanding repayment of the difference within 30 days. Unable to meet this sudden obligation, they were forced into layoffs and nearly bankruptcy. To protect yourself: 1. Always read the fine print regarding demand clauses. 2. Maintain relationships with multiple lenders. 3. Never use more than 70% of your line for extended periods. 4. Consider establishing multiple smaller lines instead of one large one. 5. Negotiate removal of demand clauses when possible. I've helped clients successfully negotiate modified demand clauses that require 90-day notice periods instead of the standard 30 days. This worked for my client in the construction industry, giving them crucial breathing room during seasonal transitions. The right line of credit should be a reliable partner in your business growth, not a source of unexpected stress. The right business line of credit works as a safety net and growth accelerator. Let's recap. 1. Match your credit limit to your actual business needs. 2. Compare interest rates and fee structures. 3. Understand repayment terms, especially during your slow periods. 4. Know your qualification status before applying. 5. Choose lenders based on both rates and funding speed. 6. Watch for those demand clauses that could leave you vulnerable. Now that you understand how to choose the right line of credit, you're already ahead of 90% of business owners. But there's one more strategy that can save you even more. Consider negotiating an annual review process where your credit line grows automatically with your business performance. This prevents the need for new applications and credit inquiries as your business scales. Your business has unique needs. There's no one-size-fits-all solution. But now you have the framework to make an informed decision that supports your specific business model. I'm curious, what's the biggest cash flow challenge your business faces right now? Let me know in the comments, and I might address your specific situation in next week's video. Tell us what you liked about today's video by leaving a comment. A big thank you to my subscribers. We love it when you comment heart. If you're ready to explore your options, call 888-653-0124 today, or click the link in the description to learn more and share your success story. Need more financial strategies for your growing business? Hit that subscribe button and notification bell so you don't miss our upcoming video on tax strategies for businesses earning over $100,000 monthly. Until next time, we are helping you make smarter financial decisions for your business.